If you are looking for information on how to improve your debt to income ratio so you can qualify for more mortgage, then you're in the right place. Hi, my name's Scott Hastings. I'm a loan officer based in Charlotte, North Carolina, and I help people get mortgages in North Carolina, South Carolina, Florida, and Virginia, with more states to come. So in this video, I wanted to give a real world, loan officer knowledge-based explanation of debt to income ratio. There's a lot of videos out there and a lot of, I would say, misinformation out on the internet. So in this video, I want to talk about A, what is debt to income ratio? B, how it is calculated. C, what's included in your debt to income ratio. D, what's not included in your debt to income ratio. And then E, F, G, etc. Ways that you can improve the debt to income ratio, and also why this matters. So first, what is debt to income ratio? Very simply, the debt to income ratio is what lenders use to figure out how much mortgage you can qualify for. So lenders will take your income, your monthly income, before taxes are taken out. That's very important. So if you're a regular W-2 employee, you get a paycheck, you can use the full income before taxes are taken out. And they divide that by the amount of monthly debt obligations that you have, including the mortgage that you want to get. And there's going to be a maximum amount that you can qualify for. And that's what the debt to income ratio is. So why does this matter? There's a lot of factors involved in this, but there's different mortgage types. There's an FHA mortgage, there's a conventional mortgage, there's a USDA mortgage, there's a VA mortgage, a jumbo mortgage, and all these different mortgage types are going to have slightly different debt to income ratio thresholds. What I see often is that the main thing that people can sometimes do if they don't have a great credit score is to improve the credit score so you can have more room in your debt to income ratio to get a mortgage. And what I mean by that is if I take, say, an FHA loan, for example, and I'm going to use a credit score of 620, then I find that if you have between a 620 and a 640 credit score, your debt to income ratio level is not going to probably be able to go over about 36%. That means 36% of your total income could go towards debt obligations. But in my experience, if you can just get the credit score to a 640, then we can usually get the credit score, debt to income ratio to go up to 45% and higher. And so that would be one of the first things I would look at. Now, I have other videos, and if you have questions about how to increase your credit score, we can go over that. But what I typically find is that it's credit card obligation, so lowering your credit card balances. So the debt to income ratio is made up of two parts when it comes to a mortgage. There's what they call the front end debt to income ratio. That is only your housing payment. So whatever house you want to qualify for with the principal and interest on the mortgage, plus the real estate taxes, plus the homeowner's insurance, plus any HOA dues and mortgage insurance. That is going to be a lower number. So typically on an FHA mortgage, for example, with over a 640 credit score, I find that you can go up to about 46% of your income could go towards the debt income ratio for the mortgage payment. Now, if you have a higher credit score, and this is also another video, what's the difference between an FHA mortgage and a conventional mortgage? If you have a higher credit score, and I'm just going to say at least a 680, probably over a 700, then you could possibly look at a conventional mortgage. Now, the difference on a conventional mortgage is that the front end ratio and the back end ratio typically can be the same. And that means that you could probably go up to 49 or 50% of your total income could go towards all debt. And just an example, if you didn't have any other debts on your credit report and you only were qualifying for the mortgage payment, 50% of your monthly income before taxes could go towards your mortgage payment. Obviously, that's not usually the case. So that brings up the next question. What is included in your debt and income ratio? Basically, when we run a credit report, when a lender runs a credit report, whatever payments show up as the minimum payment that's acceptable by the creditor shows up on the credit report. So, for example, you'll notice when you get your credit card statement, there's always a minimum payment. That's what's going to be reflected on the credit report. It's not necessarily what you send in, it's what the creditor will accept. A car loan, obviously is going to be whatever the car payment is going to be reflected on the credit report. Also, student loans are a huge thing. Student loans, again, with each mortgage type, and this is why you should contact me or another mortgage professional, are going to have different thresholds for the payment. But in general, if you have a student loan and it's in deferment, you're not making any payments on it, when we pull a credit report, if there's no payment reflected, then we either have to use 1% or in some cases, 0.5% of the total student loan balance and consider that as the payment in your debt to income ratio. So those are all the things that are reflected on the credit report. Some other things that I see people forget about often that are also included in the debt to income ratio are things like alimony. So if you're divorced and you have monthly alimony payment, that's going to be included in your debt to income ratio. Also, child support. I see this missed often. If you have child support payments due, then that's going to be included in your debt to income ratio. What's not included in your debt to income ratio? So a lot of times clients will call me and I'll say, so what's your credit like? And they'll start to kind of tell me. And I hear them say things like, well, I have a car loan, but I only owe about $5,000 on it. It doesn't really matter what the balance is on the car loan, for example. It only matters what the payment is. Things that aren't on the credit report, things that are possibly on the credit report that aren't counted are, let's say that you have what's called a charge off. So you have a debt, or maybe it was a credit card, who knows what kind of, debt went bad. You just quit paying it. And eventually the creditor just gave up and they did what they call, they charged it off. So they wrote it off of their books. That does not have to be included in your debt to income ratio. Also, medical collections, they don't have to be included in your debt to income ratio. Now, of course, there's other guidelines around this, and this is why you should contact your loan officer. If you have over, on a FHA loan, for example, if you have over $5,000 in collections, outstanding collections, then we have to figure 5% of the total collections as the payment that we include in your debt to income ratio. So as you can tell, there's a lot of factors. By the way, if you're finding this video helpful, it would help me a lot if you would hit like and subscribe. And if you have any questions, put them in the comments and I'll be happy to answer them. So what are some ways that you can, lower your debt to income ratio? First of all, I always look at the credit report and I look at the payments and then I look at the balances. So obviously the only way to lower your debt is to pay something off. So I would look at the trade lines that have the highest payments. So let's say, for example, you have a car loan that's got a $500 a month payment, and you have, 13 or 14 months left on it. And you had the money to pay it off. Well, that might be and probably would be the best thing to pay off, because that's going to increase your ability to borrow on a mortgage by $500 a month, which is a lot. You know, then I would be looking at credit card payments, and I would be looking at whatever's the highest minimum payment. So a lot of times, even though the balances are different, certain credit card companies will require a higher minimum payment. So I would, you know, look to pay off whatever has the highest payment. And another note on this, you don't have to pay these off right away. We can pay off debts at closing. So what we would do is we would just mark these debts to be paid at closing. And then the closing attorney or the escrow company would be directed, as part of the instructions from the lender, to send checks to those creditors at closing to pay those off. And that would just be additional money that you would bring to closing. You know, a lot of times I talk to people about a gift. A lot of times, obviously, people don't have enough money to pay these off, but they could possibly get a gift from a parent or a relative or someone. You're allowed to get a gift to pay these debts off at closing. There are certain ways it has to be documented and all that stuff, but you know, that is another option. You know, a lot of times what I'm looking at as well are like homeowners insurance premiums. Depending on where you are in the country, you probably notice homeowners insurance premiums are going way up. Well, I would shop for a lower or the lowest homeowners insurance premium you can get. You could always change it later, but that can make a big difference in your debt income ratio and help you qualify just to get that little bit more of a house. You know, also, if you are a first-time home buyer, there's something called a mortgage credit certificate. Now, I used to use these a lot. I haven't used them recently much, just the way the current market is, but this can be a pretty powerful tool, and it's really good for anybody. What a mortgage credit certificate is just like a child tax credit. At the end of the year, when you file your taxes, you're allowed to have a credit of up to $2,000 a year taken off of your taxes. And if you meet certain income requirements, and this is household income requirements, and is determined by county and state, then you're allowed to get up to this $2,000 credit. And what we as the lender can do is we divide that by 12, and you can add $166 a month to your income, which, you know, allows you to obviously lower your debt income ratio a little bit, / increase your borrowing ability a little bit. So that's something I would be, you know, asking about if you think you might fit into that category. Of course, a first-time home buyer. So again, this could be a pretty broad topic, but these are some really good basic informational points on what debt income ratio is, how you can lower your debt income ratio, what's included in the debt income ratio, what's not included in the debt income ratio, and how credit score can affect that. One more thing I wanted to add that I just remembered is mortgage insurance and credit score. This can make a massive difference if you're getting a conventional loan. Mortgage insurance is greatly affected by credit score, and that can really screw up your debt income ratio. So that's another good reason to get your credit score up. And that's another reason that I find myself looking more at FHA loans in certain situations now. The reason is it doesn't matter what your credit score is on an FHA loan. As long as you are approved, the mortgage insurance is going to be the same amount. So I hope you found this video helpful. It probably answered some questions. It might have also opened up some other questions you have. And if you have any questions, please put them in the comments or go to my website, mortgagesbyscott.com, You can contact me through there if you'd like to be qualified for a mortgage or pre-approved. I'd be happy to help. Thanks a lot. Oh, and click like and subscribe if you haven't. Thanks.